For years, SpaceX was the most valuable private company that ordinary investors simply could not touch. Elon Musk's rocket firm was widely regarded as one of the greatest missed opportunities in modern investing history, a business reshaping an entire industry, locked away behind closed venture capital doors. Then, on the 12th of June, 2026, all of that changed. SpaceX finally went public. And the question on every investor's lips right now, on Sunday the 5th of July, 2026, is a very simple one. If you put $1,000 into SpaceX at its opening price, what is that stake actually worth today? The answer is more nuanced than you might expect, and understanding it could genuinely inform one of the more interesting investment decisions available to you right now. Before we talk about share prices and returns, it is worth understanding exactly what you are buying when you invest in SpaceX, because this is not simply a rocket company. SpaceX operates across three distinct divisions. The first is its space division, which handles launch services. SpaceX conducts more orbital launches annually than any other launch provider on Earth, more than national space programs, more than all European launchers combined. That is an extraordinary commercial moat. The second division is connectivity, which operates Starlink, the low Earth orbit satellite broadband network that now serves millions of subscribers across more than 100 countries. Starlink is generating substantial recurring revenue and is arguably the fastest-growing broadband provider in history. The third division covers artificial intelligence, encompassing Grok, the AI assistant, as well as involvement in the X social platform and a growing network of data centers. Three businesses, one ticker, and that layered diversification is precisely why so many analysts have been eagerly awaiting this IPO. SpaceX priced its initial public offering and began trading on the 12th of June, 2026, marking one of the most anticipated stock market debuts in recent memory. The opening generated enormous retail and institutional interest, with analysts from multiple major Wall Street firms issuing buy ratings almost immediately. The company is headquartered at its Starbase development site in Texas, the same facility from which its Starship rocket launches, giving the brand a tangible, operationally significant home that differs markedly from a typical tech firm. The IPO was structured to reflect SpaceX's status as a genuinely multi-sector enterprise, incorporating launch revenues, Starlink subscription income, and its growing AI footprint into a single valuation. Early trading days saw substantial enthusiasm, pushing the stock up sharply from its opening price, which is exactly the kind of post-IPO momentum that catches the attention of both growth investors and momentum traders. Here is where things get interesting, and where investors need to pay close attention. As of this weekend, the 5th of July, 2026, SpaceX shares have pulled back from their post-IPO highs. This is not unusual. Almost every high-profile IPO experiences a period of price correction as early buyers lock in profits and the market recalibrates around a more sustainable valuation. The practical implication for anyone who invested $1,000 at the opening price is that the exact return depends heavily on timing. Those who bought at the initial offering price have seen their stake move in line with that post-IPO arc, an initial gain followed by a pullback. Those who bought at the very peak of post-IPO excitement are currently sitting on a modest paper loss. And those watching patiently from the sidelines are now assessing whether this dip represents a buying opportunity, which is precisely the question Wall Street analysts have begun to answer very publicly this week. Despite the share price pulling back from its highs, analyst sentiment on SpaceX remains strongly bullish heading into July 2026. Several major financial institutions have published forecasts suggesting that a $10,000 investment made at or near current prices could be worth considerably more within the next 12 months. The bull case rests on three pillars. First, Starlink's subscriber growth trajectory, which continues to expand aggressively in underserved markets across Africa, Southeast Asia, and rural North America. Second, SpaceX's launch cadence. No competitor is currently close to matching the volume, reliability, or turnaround speed of its reusable Falcon 9 fleet. And third, the Starship program, which if it reaches full commercial operational status, would represent a step-change reduction in cost per kilogram to orbit, dramatically expanding the addressable market for both commercial and governmental payloads. These are not speculative promises, they are programs already in execution. No serious investment analysis is complete without an honest look at risk, and SpaceX carries several that are specific to its unusual structure. The company's fortunes are closely tied to Elon Musk, who simultaneously leads Tesla, xAI, and a range of other ventures. Keyman risk of this scale is genuinely significant. Additionally, SpaceX operates in a capital-intensive industry, rockets are extraordinarily expensive to develop, test, and operate, and a high-profile failure can have both financial and reputational consequences. There is also regulatory exposure. SpaceX's launch licenses depend on relationships with bodies like the Federal Aviation Administration in the United States, and any shift in regulatory posture could delay launches and affect revenue timelines. Finally, competition is intensifying. Blue Origin, Rocket Lab, and a range of Chinese state-backed launch providers are all investing heavily to chip away at SpaceX's dominance. These risks do not necessarily make SpaceX a poor investment, but they make it a complex one, and investors should weigh them honestly. For most retail investors, the question is not simply whether SpaceX is a good company, it clearly is, but whether it belongs in a portfolio and in what proportion. SpaceX sits firmly in the high-growth, high-volatility category of equities. Its valuation is based substantially on future earnings potential rather than current profitability, which means the share price will likely remain sensitive to macro interest rate movements and broader risk-off sentiment in markets. A common approach among growth-oriented investors is to treat a stock like this as a satellite holding, a smaller allocation, perhaps 5 to 10% of a portfolio, positioned to benefit from asymmetric upside without exposing the broader portfolio to undue concentration risk. For those with a longer time horizon, 10 years or more, the case for holding SpaceX through volatility is arguably stronger, given the structural growth runways that Starlink and the Starship program represent over that time frame. SpaceX going public on the 12th of June, 2026 is not just a corporate milestone, it is a marker of how profoundly the space industry has transformed over the past decade. What was once the exclusive domain of government programs funded by taxpayers is now a commercially competitive, investor-accessible sector generating real revenue from real customers. Starlink is billing subscribers monthly. The Falcon 9 is flying paying customers to orbit on a near-weekly cadence. And Starship, if it fulfills its potential, could open up lunar logistics and deep space commerce within the next decade. For investors, the SpaceX IPO represents the first clean opportunity to hold a direct stake in this transformation. Whether your entry point is at today's post-correction price or you choose to wait for further consolidation, the underlying thesis, that the commercialization of space is one of the defining investment themes of the coming decade, appears more intact today than it did before the IPO. Let us bring this together clearly. SpaceX went public on June 12, 2026 after years of being off-limits to ordinary investors. The stock rallied strongly post-IPO and has since pulled back from its highs, which, depending on your perspective, is either a warning sign or an entry opportunity. A $1,000 investment at the IPO opening price has tracked that arc, up sharply, then back. Wall Street analysts remain bullish for the year ahead, citing Starlink growth, launch dominance, and Starship commercialization as the key drivers. The risks of keyman concentration, capital intensity, and regulatory exposure are real and should be factored into any position sizing decision. But the longer-term structural story is genuinely compelling. If you are considering adding SpaceX to your portfolio, do your own research, consult a financial advisor if appropriate, and remember that past performance, even a very exciting IPO, is never a guarantee of future returns. That said, this is one of the most consequential new listings of 2026, and it deserves serious attention.